Have you ever felt like you're just drowning in information when you're trying to make smart decisions about your money? You've got stacks of articles, maybe some research papers, but how do you figure out what's really important? It can feel like trying to drink from a fire hose. We all want to be well informed, right? Especially about our financial future, but without getting totally overwhelmed by jargon and, well, endless pages.
That's a feeling I think many people can definitely relate to. Today, we're taking a deep dive into a really crucial part of Malaysia's financial landscape, collective investment schemes. We'll shine a spotlight on two vital categories: unit trust schemes, or UTS, and private retirement schemes, known as PRS. Now, these are powerful tools for building long-term financial well-being, but understanding their mechanics, the benefits, and crucially, the risks involved, well, it can often seem incredibly complex. So our mission here is pretty simple: to demystify it all for you. We want to provide clear insights into how these schemes actually operate and why they matter so profoundly to your financial journey.
Right. And to make sure you're getting the absolute core of what matters, our insights today are drawn straight from a comprehensive study guide. This isn't just, a basic overview. It's the kind of material designed for people actually looking to pursue a career in this very industry. So you can be confident we're extracting the most critical information from the foundations up, really giving you a truly well-informed perspective. Okay, let's unpack this whole concept then. Collective investment schemes, or CIS. Imagine you want to invest in a wide range of assets, stocks, bonds, maybe even international markets, but you don't have millions of ringgit or, the specialized knowledge and the time to research every single company or market trend. This is where CIS steps in, kind of like your personal investment co-pilot.
That's actually a great way to put it. CIS is essentially a financial arrangement where a multitude of investors, including you, pool their funds together. This collective pot of money is then professionally managed by licensed fund managers who invest it in a diversified portfolio. That could be securities, derivatives, other assets, all according to a defined strategy. The core purpose of CIS is really to bridge that gap between traditional low-risk options like bank deposits and the potential for much better returns that come from broader market opportunities. It provides an ideal avenue for investors with, let's say, smaller capital, but also for high net worth individuals to gain exposure to markets and asset classes that might otherwise be completely out of reach for them.
So it's like a shortcut then to being a sophisticated investor. You get all the perks without needing to be a full-time market analyst yourself.
Exactly. You gain access to sophisticated professional fund management, that inherent diversification across many assets, and the potential for higher returns than, say, basic savings accounts. All of this without needing huge amounts of capital or deep personal expertise in market analysis. What's truly fascinating here, I think, is how CIS fundamentally addresses a core challenge for retail investors: accessibility and expertise. Historically, individual investors, often acting on limited information or maybe even rumors, could actually contribute to market volatility. CIS helps mitigate this by centralizing management with licensed professionals, establishing clear investment objectives, and providing that diversification that would be incredibly difficult, almost impossible, for an individual to achieve alone. Think about it. An individual investor with, say, 500 ringgit. They couldn't possibly directly invest in a diverse portfolio of corporate bonds or multiple international companies.
Right, no way.
But through a CIS, they absolutely can. This structure fosters a more stable and hopefully informed investment environment. It brings professional market participation to the masses and allows the broader capital market to mobilize savings into productive areas of the economy. Hashtag 1.2 types of collective investment schemes in Malaysia. A crucial distinction.
So now that we understand what a CIS is, basically, how are they typically categorized in Malaysia? Is it straightforward?
Broadly, there are two main categories. You've got unlisted funds and listed funds. Our deep dive today is primarily focused on the unlisted variety, but understanding the difference is really key to seeing the whole picture.
Okay, let's start with enlisted funds then. What makes them distinct? What does that actually mean for an investor?
Right. Unlisted funds, like the unit trust schemes and private retirement schemes we're focusing on, are those whose units are not quoted or directly traded on a stock exchange like Bursa Malaysia. Their selling and repurchase unit prices are determined differently. First, you value all the fund's underlying investments to calculate its net asset value, or NAV. That's essentially the total value of all assets in the fund, minus its liabilities, divided by the number of units out there. These funds are typically open-ended, meaning the fund size isn't fixed, and you, as an investor, can usually buy and sell units at almost any time, though some might have a closed-end structure with a fixed number of units.
Okay, and what are the main examples of these unlisted funds that, our listeners would most likely actually encounter?
The primary examples are unit trust schemes, or UTS. These are arrangements under a trust managed by professionals, letting investors pool funds and share potential profits from diverse portfolios. Then there are private retirement schemes, PRS. Similar structure, but specifically designed for long-term retirement savings, with benefits tied directly to your contributions and the investment performance. And finally, just for completeness, there are wholesale funds. These are basically UTS, but offered exclusively to sophisticated investors. That's a term defined by the Securities Commission, including accredited investors or high net worth entities and individuals. But for most individual investors like yourself, UTS and PRS are the main gateways into collective investment. Understanding unlisted basically means you engage directly with the fund provider or their registered distributors, not through a stockbroker on an exchange.
Got it. So if that's unlisted, what about listed funds? How do they differ in practice?
Listed funds, in contrast, are quoted and traded on a stock exchange, like Bursa Malaysia. Their market price isn't based on NAV calculations in the same way. It's determined purely by the forces of demand and supply from investors on that exchange, just like regular company shares. Examples include closed-end funds. These are listed companies investing in other shares with a fixed number of units. You also have real estate investment trusts, or REIT funds that own and manage income-producing commercial real estate, generating rental income, and exchange-traded funds, ETFs. These are funds that track an index but trade like shares. The first ETF in Malaysia, for instance, was launched back in July 2005.
Okay, now here's where it gets really interesting and maybe a bit confusing. A place where you need to pay very close attention. It's a critical distinction. Investment-linked funds. On the surface, an investment-linked fund might sound just like a unit trust, right? You're pooling money, there's professional management, but there's a crucial difference you need to know about its regulation. These are promoted by life insurance companies. You acquire a life insurance policy that represents units in an investment pool managed by the insurer. Your premiums, after the cost of insurance cover and any entry fees, are allocated to separate investment pools.
Exactly. And the key difference, this is fundamental to how your investment is protected and overseen, is that investment-linked funds are not subject to monitoring by a scheme trustee, nor are they under the direct scrutiny of the Securities Commission, the SEC. Instead, they fall under the purview of Bank Negara Malaysia, or BNM, and they have to comply with BNM's rules and regulations.
And so does that mean they're inherently less protected or just differently protected? How should a listener weigh that up? It sounds significant.
That's an excellent question, and it really gets to the heart of it. It boils down to their primary purpose and their historical context insurance versus pure investment. BNM's mandate covers the broader stability of the financial system and consumer protection for insurance products. It focuses on the contractual obligations of an insurance policy, which just happens to include an investment component. Conversely, the SC's mandate is specifically focused on capital market integrity and investor protection for pure investment schemes like UTS and PRS. Each regulator operates within a framework best suited to the nature of the product they oversee. It reflects different approaches to risk management and consumer safeguarding. So while both involve investing, the regulatory oversight, and therefore your specific protections, are distinct. It's not necessarily less protected, but certainly differently protected under a framework designed for insurance first. It's absolutely vital that financial consultants inform investors about this significant difference. It's not just a small detail. Hashtag 1.3, the CIS ecosystem. Understanding who does what.
Okay, so when you invest in a collective investment scheme, it's not just your money vanishing into some black box, right? There's this whole, finely tuned orchestra of players, each with a crucial role to ensure transparency and protection. It sounds like a complex dance with many layers of accountability. So who are the key players in this ecosystem?
Well, first and foremost, you've got the unit holders or members. That's you, the investor. Your rights are clearly stipulated in the scheme deed and the offering documents, like the prospectus for a UTS or the disclosure document for a PRS. It's absolutely essential to read and understand these rights. They are your legal protection. Think of it as your investor's bill of rights, really.
And who's actually managing the money day to day? The ones making the decisions?
Those are the management companies. For unit trust schemes, they're called unit trust management companies, or UTMCs. For private retirement schemes, they're PRS providers. These are the professional fund managers responsible for the day-to-day operation and administration of the CIS. They're licensed by the SC and bear the ultimate responsibility for the fund, even if they outsource certain functions like, say, investment management or fund accounting. They are the ones making the active investment decisions for the pooled funds, aiming to meet the scheme's stated objectives.
Okay. Next up, and this is where it gets really interesting in terms of protecting me, the investor, is the trustee. I've heard they're indispensable. How do they truly safeguard your money? What's their core function?
The trustee. Yes, they are an independent body acting solely in the best interest of investors, safeguarding their rights and assets. The cornerstone of investor protection here is their custody of assets. This is critical. All assets of a scheme are held in the trustee's name for safekeeping, and this is vital, must be separately identified from the management company's own assets. This is a huge protection. It means if the management company were to face financial difficulties or even insolvency, your invested capital is ring-fenced. It's legally protected and can't be claimed by their creditors. It ensures the security of your beneficial interest. The trustee also monitors the scheme's operations and compliance with the deed and relevant laws, acting like an independent watchdog over the fund managers.
That's a massive reassurance knowing your money is truly separated and protected, even if the management company itself runs into trouble. Who else is part of this system?
Following that, we have the distributors and consultants. These are the individuals and entities like Institutional Unit Trust Advisors, IUTAs, and Corporate Unit Trust Advisors, CUTAs, who market and distribute the schemes to you. They play a vital, direct role in connecting investors with schemes and must be registered with FEMM, that's the Federation of Investment Managers Malaysia, and adhere to strict ethical guidelines. They're often your primary point of contact and guide.
And then overseeing all of this are the regulators. Who are the main players keeping everyone in check?
The Securities Commission Malaysia, or SC, is the primary capital market regulator for CIS. Their main objective is ensuring the proper functioning of the UTS and PRS industry, promoting market stability and robust investor protection. This includes everything from ensuring proper disclosure of information to preventing improper market practices. Bank Negara Malaysia, or BNM, is also involved, primarily in regulating areas like anti-money laundering, countering financing of terrorism, AML-CFT, and foreign exchange matters, especially concerning overseas investment activities. Bursa Malaysia, the stock exchange, oversees aspects related to listed schemes, ensuring listed issuers meet regulatory obligations. And the Federation of Investment Managers Malaysia, or FIFAM, acts as a self-regulatory organization, SRO. It plays a crucial role in advocating for the industry's growth and, importantly, directly regulates the marketing and distribution activities of UTS and PRS.
And specifically for private retirement schemes, there's another key player, isn't there? The PPA.
Yes, that's right. The Private Pension Administrator, or PPA. Approved by the SC, the PPA provides efficient administration, industry advocacy, and development for the entire PRS industry. It acts as a central repository of information and data for PRS members, which really helps enhance overall administrative efficiency. This whole intricate ecosystem is meticulously designed, really, to build investor confidence and ensure the proper functioning of the capital market. The layered oversight, particularly having the independent trustee safeguarding assets, and the PPA streamlining the PRS experience, is absolutely fundamental to investor protection and market integrity. It's all about establishing trust through transparency and accountability, making sure the system is robust enough to protect your hard-earned savings.
Okay, so we've established what collective investment schemes are and who's involved in making them work. Now, let's zoom in on the two big ones for most people. Unit trust schemes, or UTS, and private retirement schemes, or PRS. They might look similar on the surface, right? Like two different paths to financial growth, but their governing rules and underlying purposes differ quite significantly. And understanding this is absolutely crucial for your decision-making. Let's kick things off with what they actually have in common.
Fundamentally, yes. Both UTS and PRS share several core characteristics. They both provide diversification of assets, spreading investments across various instruments to mitigate risk. That's a key benefit. In both schemes, a trustee plays that vital role we discussed, looking after the interest of the investors or members. They both involve the pooling of savings by investors, with these savings invested according to defined objectives and guidelines. And crucially, both are designed as schemes that encourage you, the investor, to make long-term savings and investment decisions. That long-term perspective is key to both.
So while they share these core investment principles, where do the differences really start to appear? Because that's where the strategic choices come in for listeners, isn't it?
That's exactly right. The differences are where the real strategic thinking lies for you. Firstly, their regulatory framework. While both fall under the SC's oversight, PRS is governed by a distinct set of rules and regulations. Notably, this includes the establishment and oversight by the Private Pension Administrator, the PPA, which is approved by the SC. This creates a specialized framework specifically designed for retirement savings.
And that specific framework leads directly to their primary purpose, doesn't it? One's more general, one's laser-focused.
Precisely. Unit trust schemes serve as a general investment vehicle. They're suitable for a wide range of financial goals, saving for a house deposit, a child's education, or just general wealth accumulation over time. Private retirement schemes, however, are specifically designed for building long-term savings for retirement. That singular focus means they have different operational rules, all designed to encourage and protect those long-term retirement savings.
And this singular focus on retirement for PRS leads to a major differentiator that you absolutely need to understand: the withdrawal rules. How did they compare? This sounds critical.
This is a critical distinction, yes. With PRS, your contributions are split into two sub-accounts. Sub-account A holds 70% of your contributions. Generally, you cannot withdraw from it until you reach retirement age, currently 55, or in specific cases like death, permanent departure from Malaysia, permanent total disablement, serious disease, or mental disability. Only contributions into sub-account B, which holds the other 30%, may be withdrawn once a year. However, these pre-retirement withdrawals are subject to an 8% tax penalty, although there are exemptions for very specific circumstances like housing or healthcare needs. Now, contrast that with a unit trust scheme. Investors generally have the right to dispose of their units or make withdrawals at any time, subject to the specific conditions of that individual unit trust scheme, of course. And importantly, there are no such broad tax penalties for withdrawals. It's a huge difference in flexibility versus enforced discipline for retirement saving.
That really drives home the retirement focus of PRS. What about making things simpler for investors? Do they have a kind of default option if you're not sure what to pick?
That's another key difference.
Yeah.
The default option. If a member doesn't actively specify a fund selection within a PRS, an age-based fund will be chosen by default as their core fund. So this means a conservative fund for those aged 55 and above, a moderate fund for those between 45 and 54, and a growth fund for those below 45. The aim is to simplify initial investment choices, particularly for people less familiar with fund selection. For unit trust schemes, however, there is no default option. Investors must explicitly specify the type of fund they wish to invest in before any transaction can take place. You have to make an active choice.
And who doesn't love a good tax incentive? That's another area where PRS stands out, isn't it?
Indeed. Private retirement schemes offer specific tax relief for individuals who contribute. Currently, that's up to RM3,000 per annum for contributions made from 2012 right through to 2030. Employers contributing to PRS for their employees may also enjoy additional tax deductions, capped at 19% of remuneration. Plus, all PRS funds are tax-exempt from interest income received, which can effectively boost your net returns. Unit trust schemes, in contrast, don't typically come with these specific tax incentives just for contributing.
And finally, what about moving your money around between different providers? Is one easier than the other?
That leads to portability. A distinct advantage of PRS is its portability feature. It allows members to transfer their accrued benefits and holdings between different PRS providers without needing a full redemption and then a new application. This feature promotes competition and encourages good performance among providers, which is good for you. While it's possible to move between different unit trust management companies, UTMCs, it typically involves a redemption from the existing UTS followed by a new application to the new UTMC, rather than a direct transfer. Switching usually refers to moving between funds within the same UTMC. So understanding these distinctions is absolutely critical. It helps you make an informed decision about which scheme truly aligns with your financial goals and your life stage. The tax incentives and those stringent withdrawal restrictions of PRS are deliberately designed by the government to strongly encourage and facilitate long-term, disciplined retirement savings. It's directly addressing a national concern about retirement adequacy and the longevity risk posed by increased life expectancies. Hashtag 2.2, navigating fund categories within schemes, tailoring your investment.
Okay, this is where you really start to tailor your investment, isn't it? It's not just investing in a fund. It's about finding the right fund that aligns precisely with your personal financial goals, your time horizon, and importantly, your comfort level with risk. It's about being intentional with your money. Thankfully, both UTS and PRS offer a wide array of fund categories, allowing for highly customized portfolio construction. The key takeaway here isn't to memorize every single fund type, but to realize the power of choice. It's about finding the investment clothing that perfectly fits your risk tolerance and life stage, whether you're a bit of a daredevil or prefer the slow, steady path.
Exactly. These funds are typically categorized in a few key ways. First, by asset class. This helps define the underlying investments and, consequently, the risk-return profile. You have equity funds. These are very common in Malaysia, investing predominantly in shares of listed companies, both domestic and overseas. Their performance is closely linked to share markets, so they offer higher potential returns, but also higher volatility, more ups and downs. Then there are fixed income funds. These invest in instruments that pay a fixed rate of return, like Malaysian government securities, MGS, and corporate bonds. The objective here is usually regular income, with less emphasis on capital growth. Generally, these funds exhibit lower volatility and risk compared to equity funds. They can be a useful tool for reducing overall portfolio risk, given their potential negative correlation with equity returns, meaning they might go up when equities go down sometimes.
So fixed income sounds less exciting, maybe, but more stable. What about really short-term options, almost like a supercharged savings account?
Right. For shorter horizons, or if you need quick access to your cash, there are money market funds. They operate similarly to a bank account, investing in low-risk, highly liquid money market instruments like short-term deposits and debt securities. They typically have no entry or exit charges and provide regular, frequent income distributions. This makes them ideal for short-term investments or as a highly liquid component of a broader portfolio, a place to park cash temporarily. Finally, we have mixed asset funds, often called balanced funds. These aim to offer a blend of growth and stability by investing across major asset classes, equities, fixed income, cash, sometimes property, usually through listed REITs or real estate company shares, as direct property investment isn't generally allowed for UTETs. They offer lower volatility than pure equity funds while providing prospects for higher returns than money market or fixed income funds. They can be structured with a higher growth asset component for those more comfortable with risk, or more defensively for lower risk profiles. The asset allocation is often actively managed in response to market movements.
Okay, so those categories are based on what they actually invest in. How else are funds categorized? Are there other ways to slice and dice them?
Yes, they can also be categorized by fund structure, which defines how the fund is actually put together. For instance, you have index funds. Their principal objective is to track, replicate, or correspond to a specific market index, like the FBMKLCI. Their aim is simply to provide investment results that closely match the performance of that chosen index by investing in the securities that make up that index. Less active management, more mirroring the market. Then there are fund-to-funds. These are quite interesting because they don't invest directly in individual stocks or bonds. Instead, they invest in units or shares of other collective investment schemes. For example, a fund-to-funds has to invest in at least 5 underlying CIS at all times, providing a sort of meta level of diversification of managers in a way. Lastly, there are government-sponsored unit trust schemes. These are a specific type of UTS that might invest on a balanced basis, sometimes with a fixed RM1 stellar euro unit price and an earnings rate credited annually, or predominantly in equities with a fluctuating unit price. Think ASNB funds, for example.
And finally, how do the fund's stated goals, what it's actually trying to achieve, play into this categorization?
That's categorization by investment objectives. This directly guides the fund's strategy and the expected outcomes for you. Capital growth funds are primarily invested with the objective of increasing the unit price over time. They typically pay very low or maybe even no annual distributions. These funds are generally associated with higher risk and volatility, as their focus is purely on long-term capital appreciation. Income funds, conversely, are focused on generating regular income. They invest primarily in companies expected to pay consistent dividends or in fixed income securities that pay interest. Lastly, growth and income funds employ a hybrid approach. They invest in a mix of companies, for example, smaller companies for growth potential and well-established ones for dividends to provide both capital appreciation and regular income. This diversity within UTS and PRS allows for really highly customized portfolio construction. A crucial insight here is that concept of the risk-return trade-off. Generally, funds with higher potential returns will come with higher volatility and capital risk.
Your time horizon, how long you plan to invest, and your personal risk tolerance are absolutely paramount in making suitable choices. A good consultant will definitely guide you through assessing that. #tax, #2.3 effective investment strategies, and the tangible benefits of schema investing.
Okay, so beyond just choosing the right fund, How you invest can make a huge difference to your long-term success, can't it? There seem to be two main approaches. Putting in a big chunk all at once, the lump sum, versus saving regularly. A lump sum investment means you put in a significant amount up front, and over time, that initial investment is expected to grow as dividend income and capital gains are earned and compounded within the scheme. Simple enough. But for many people, especially those with smaller capital, maybe just starting out, a regular savings plan sounds incredibly appealing. This involves making consistent, smaller contributions, maybe monthly through a direct debit. It's a disciplined, flexible, and often highly effective way to accumulate wealth over time, and usually without contractual penalties if you need to stop contributing for a while.
And this leads us directly to one of the most powerful strategies, especially for regular savers, dollar cost averaging.
Yes. This is one of my favorite aha moments for investors because it sounds technical, but it's actually a brilliant, disciplined way to invest. It takes the emotion out of trying to predict market highs and lows, doesn't it? The concept is basically the systematic and regular investment of a fixed amount of money into a scheme, say RM100 every month, irrespective of the unit price level at the time of investment. Because your fixed amount buys more units when prices are low and fewer units when prices are high, it effectively helps to reduce the average cost of the units you acquire over time. It helps you ride out those market waves by consistently investing that fixed amount, ensuring you buy more when prices are low, like during market dips. This effectively smooths out the impact of market volatility and removes the emotional decision-making of trying to time the market. This strategy can really enhance performance during periods of both declining and rising prices, provided, of course, it's used consistently over long periods.
Its real value, I think, lies in promoting that consistent investment discipline. It leverages market fluctuations to your advantage by acquiring more units when prices are perhaps undervalued and fewer when they seem overvalued, thereby smoothing out your average purchase price over the long term. For example, if you consistently invest RM100 and the unit price drops from RM1.00 to RM1.80, your RM100 buys 125 units instead of 100. When it rises back to RM1.00, your RM100 buys 100 units. Over time, your average cost per unit would be lower than if you'd bought all units at the higher price. But it's crucial to remember, while it's a sound strategy, it doesn't offer guarantees of investment performance. It only helps with the mechanics of accumulating units efficiently over time.
Okay, so beyond these smart strategies like dollar cost averaging, what are the real tangible benefits of choosing to invest in these collective investment schemes in the first place? Why bother instead of, say, just buying a couple of stocks?
There are several compelling advantages that make CIS a real game changer for many investors. First, enhanced diversification. A larger pooled fund allows fund managers to purchase a wide range of investments, think 20 to maybe 100 different company shares in an equity scheme. This significantly reduces risk compared to an individual investing all their capital in just one or two assets. This portfolio effect leads to less volatile investment returns. For example, if you had RM10,000 invested in a single stock that fell by 20%, your investment is now worth RM8,000, an RM2,000 loss. But if that RM10,000 was diversified across a portfolio where only one stock fell 20% while others held steady or even rose, your overall portfolio loss might be closer to, say, 10%. Or RM1000. It effectively minimizes overall losses by spreading your risk.
Spreading your risk makes a huge difference, clearly. And what about getting your money out when you need it or just knowing what it's worth at any given moment? Is that easier with these schemes?
That leads to robust valuation and high liquidity. Most schemes conduct regular valuations at least daily for most active funds, maybe monthly for less liquid assets, ensuring objective, independent, and verifiable pricing. So you always know the current value of your investment. Moreover, scheme providers are legally obligated to repurchase an investor's units upon request, with proceeds typically paid within 7 business days. This high liquidity is a significant advantage over direct investments in illiquid assets like property, which can be very difficult and time-consuming to sell quickly when you need the cash.
And what about that professional touch? It really sounds like you're tapping into some serious expertise without being an expert yourself.
Absolutely.
Yeah.
For investors unable or unwilling to research and analyze markets themselves, these schemes are ideal because they offer access to professional management. You gain access to the technical expertise, the extensive research resources, and the strategic asset allocation decisions of professional fund managers. And they're supported by robust internal oversight arrangements like boards of directors, Sharia advisory councils for Islamic funds, internal audit, and audit committees. Individuals with smaller capital simply cannot replicate this level of expertise and infrastructure on their own. It's like hiring a whole team of experts for a fraction of the cost you'd pay individually.
It also sounds like it opens doors to markets typically out of reach for the average person, right? Things you couldn't buy directly.
Precisely. There's broad investment exposure at lower costs. Schemes enable investors with even smaller capital, sometimes as low as RM10, to start to gain exposure to asset classes or securities that would be impossible to directly invest in. Think real estate via REITs, international stock markets, or corporate bonds. The pooling of funds also allows for lower per-unit transaction costs due to economies of scale, making sophisticated investing much more affordable. Finally, these schemes are excellent for meeting longer-term financial needs. Investments in schemes are particularly well suited for long-term savings objectives, like saving for a house, funding children's future education costs, or building up a substantial retirement fund to complement mandatory savings like EPF. The power of compounding investment returns over time makes these long-term investments particularly attractive, helping you work towards a more comfortable financial future. This intricate web of regulators is really meticulously designed to create a robust safety net for investors. It's all about fostering confidence and stability in Malaysia's capital markets. At the heart of it all is the Securities Commission Malaysia, or SC. The SC serves as the primary capital market regulator for collective investment schemes. Its main objective is to ensure the proper functioning of the unit trust scheme and private retirement scheme industry, promoting capital market stability and critically robust investor protection. This includes ensuring proper disclosure of information, controlling who can operate in the industry, preventing improper market practices, and championing good corporate governance. They even undertake initiatives to raise investors' financial and investment literacy levels, which is great. In fact, the SEC has been specifically tasked by the government to develop the PRS industry as an integral part of Malaysia's private pension landscape.
So the SC is the big one, the primary watchdog, keeping an eye on everything. But are there other regulatory bodies involved in this complex system? It sounds like there must be.
Yes, absolutely. Bank Negara Malaysia, BNM, is also involved due to its broader role in regulating areas such as anti-money laundering and countering financing of terrorism, AML-CFT, as well as foreign exchange matters. This is especially relevant concerning overseas investment activities of schemes or if insurance components are bundled in somehow. Then there's Bursa Malaysia, the stock exchange itself, which oversees aspects related to listed schemes, ensuring listed issuers meet regulatory obligations and uphold market integrity. For any listed unit trust schemes, they must meet Bursa Malaysia's listing requirements in addition to SC rules. And crucially for UTS and PRS, we have the Federation of Investment Managers Malaysia, FIM. This organization serves a dual role. It's both a self-regulatory organization, SRO, and an industry representative body. VAM advocates for the development and orderly growth of the UTS and PRS industry, and very importantly, it directly regulates the marketing and distribution activities of these schemes. It sets the rules for how your consultant operates day to day.
Okay. And what's the legal backbone that gives all these regulators their teeth? What are the laws underpinning all this?
The entire framework is underpinned by key legislation, primarily the Securities Commission Act, 1993, SCA, and the Capital Markets and Services Act, 2007, CMSA. These acts lay out the core legal foundation for the UTS and PRS industry. The CMSA specifically grants the SE extensive powers and authority over the PRS industry. Key requirements under CMSA include that SC approval is required for parties to act as a scheme provider, and that monies received from unit holders or PRS members must be kept in separate trust accounts. Prospectuses of disclosure documents must also be registered with the SC before they can be issued. The consequences of non-compliance with these rules are severe. For instance, failure to observe disclosure requirements can result in hefty fines or even imprisonment. This underscores the seriousness of regulatory adherence and the unwavering commitment to protecting investor interests. This whole intricate web really ensures a healthy, transparent, and trustworthy environment for your hard-earned savings and long-term investments. Hashtag 3.2, the crucial role of oversight functions, and the scheme trustee.
Okay, so we have these external regulators keeping a close eye on things. But what about inside the companies themselves? Are there internal checks and balances designed to protect investors from within?
Absolutely. Beyond the external regulators, scheme providers have robust internal oversight mechanisms designed to protect investors. This includes their board of directors, who are responsible for ensuring proper policies and procedures for a sound compliance framework. Importantly, independent directors on the board specifically represent and safeguard the interests of unit holders and members like you. There's also typically an investment committee or sometimes a designated individual ensuring investment strategies are efficient and proper, and consistent with Sharia principles for Islamic funds. For Islamic schemes, a Sharia Advisory Council, SAC, or Sharia Committee provides rulings, advises on Sharia compliance, reviews investment transactions, and issues reports on adherence to Sharia principles. They even apply ijtihad or intellectual reasoning to ensure all aspects are Sharia compliant. An internal audit function reports on the adequacy, effectiveness, and efficiency of management, operations, risk management, and internal controls. For PRS providers, this internal audit function reports to an audit committee, which reviews and reports to the board on the internal audit framework.
So yes, multiple layers internally.
That's a lot of internal layers, making sure everyone is playing by the rules. But let's circle back to the trustees, because you mentioned they're indispensable. How do they truly safeguard your money, perhaps more directly than these internal committees?
The scheme trustee is indeed the indispensable independent guardian of investor interests. Their core duty is to act honestly and solely in the best interest of the investor, safeguarding their rights and assets and taking all reasonable steps to ensure fair treatment. The cornerstone of investor protection, and honestly, this cannot be stressed enough, is their custody of assets. All assets of a scheme are held in the trustee's name for safekeeping and must be separately identified from the management company's own assets and those of other schemes they might trustee. This means assets cannot be sold or transferred by the scheme provider without the trustee's express permission. Even if a sub-custodian is appointed, perhaps overseas, the trustee remains fully responsible. This critical structural element fundamentally means that even if a management company faces financial distress or insolvency, your invested capital is ring-fenced and legally protected. It cannot be claimed by their creditors. This ensures the security of your beneficial interest.
So the trustee is basically your financial bodyguard, ensuring your money is ring-fenced and untouchable by anyone else. That's a huge reassurance that goes beyond just internal company policies.
Precisely. Beyond just holding the assets safely, the trustee also performs crucial income and fees oversight. They ensure the scheme receives the income it's due from its investment portfolio and that net income is appropriately distributed to investors. They also verify that fees payable to the scheme provider are reasonable and in accordance with the deed and prospectus. They maintain oversight of the investment policy and transaction monitoring, ensuring the scheme's investment policies are sound, as described in the prospectus, and that investments are not made to further the scheme provider's interests or cause detriment to investors. They actively work to prevent conflicts of interest. The trustee also supervises unit creation and cancellation, ensuring these actions comply with the deed and laws and are always in the best interest of the existing investors. They ensure accounts and audit are properly kept and independently audited annually by an approved auditor. The SEC can even direct the trustee to replace or appoint an auditor if they deem the current one unsuitable.
That's a remarkably thorough system of checks, really built from the ground up to protect the investor.
And finally, the trustee has a direct responsibility for reporting to investors and the SEC. They include a statement in the annual reports verifying that the scheme provider managed the fund according to its investment powers and regulatory requirements. If the trustee finds shortcomings, it must disclose them in the report. They have to highlight the potential impact on investor decisions and the steps taken to rectify them. Crucially, the trustee must report directly to the SEC if it believes the scheme provider has not acted in the interests of investors or in accordance with the deed or laws. This layered protection is designed to build deep trust, providing continuous assurance that your investments are being handled with the utmost integrity and always in your best interest. Hashtag 3.3 marketing, distribution, and the accountability of your consultant.
Okay, so with all these layers of protection and oversight in place, how does that actually translate to the people you deal with face-to-face, the consultants who advise you? This isn't just about selling a product, is it? It's fundamentally about building trust. These strict rules around advertising and the rigorous registration requirements for consultants, they're all there to make sure you get clear, fair, and honest information, and that the person advising you is properly qualified and held to the highest ethical standards.
Absolutely. The advertising guidelines are very strict, ensuring that all information presented to you is clear, fair, and balanced. Advertisements must not contain exaggerated, flamboyant, overstated, or overzealous messaging, as these are likely to mislead investors. They have to be factual. They must always direct investors to refer to the prospectus, the disclosure document, and the product highlight sheet, or PHS, for complete information, and state their issuance date. And any testimonials or endorsements used must be from actual investors and, critically, must disclose any compensation received by the person giving the testimonial. You can't just have someone praising a fund without knowing if they were paid to do so.
That's really important for transparency, definitely.
Well, what about the consultants themselves? Do they just need to sign up somewhere, or is it more involved?
Not at all. There's rigorous consultant registration and authorization. All persons involved in the marketing and distribution of UTS and PRS are considered to be dealing in unit trusts and dealing in PRS, respectively. As such, they must be licensed and registered. They are required to sit for and pass the FIM examination and obtain authorization from FIM. To be eligible, they must be at least 21 years old, have attained credits in any 3 subjects in SPM or its equivalent, and meet strict fit and proper criteria regarding honesty, integrity, reputation, competence, capability, and financial soundness. Consultants must also show proof of their FIM registration to investors, as specified by FIM when carrying out marketing activities. This gives you direct assurance of their legitimacy and qualifications right up front.
So they've passed the exams, they're registered, but what about their ethical compass? What guides their actual day-to-day conduct when they're sitting across the table from you giving advice?
That's where FIM's Code of Ethics comes into play. As a self-regulatory organization, FIM's code ensures ethical and professional conduct by distributors and consultants, augmenting the Securities Commission's requirements. Its core principles include things like honesty and integrity, professionalism, observance of confidentiality, fair dealing, and due care and diligence. Pretty fundamental stuff. Consultants are explicitly expected to act with honesty, integrity, and dignity, treat members with respect, disclose all pertinent information to enable informed investment decisions, and ensure all information provided is current, accurate, and complete. They must also undertake that crucial suitability assessment before recommending any product, which we'll dive into shortly.
And what if they don't follow these rules? What if they step out of line? Are there serious consequences?
Definitely. The code also clearly outlines prohibited conduct. This includes, but isn't limited to, misrepresenting the scheme, its funds, or past performance, making unrealistic claims or promises, engaging in conflicts of interest, undertaking unauthorized transactions such as churning, that's excessive trading just to generate commissions for themselves, imposing excessive charges, conducting unauthorized recruitment, or failing to obtain proper client information or consent. Consultants found to have breached the FIM Code of Ethics face serious disciplinary actions. This could include public reprimand, suspension, or even revocation of their FIM registration. FIM's disciplinary committee investigates all complaints very seriously. Compliance for a consultant isn't just about avoiding penalties. It's a critical risk management tool and, really, a cornerstone of building enduring client relationships. Adhering to the FIM Code of Ethics directly translates into increased trust and confidence from clients like you, which is honestly the most valuable asset in this industry. It proactively reduces the likelihood of complaints, minimizes potential litigation risks, and enhances the overall professional standards across the sector. It's about doing well by doing good, ensuring that your best interests are always paramount.
All right, let's talk money. Specifically, what you pay for when you invest in these schemes. Because it's not just about what your investment makes, is it? It's also about what you keep. These fees, especially the indirect ones, can quietly eat into your returns over time if you're not aware. So let's break down what you pay for and how you can evaluate it. First, there are direct fees and charges. These are the ones paid directly by you, the investor. The most common one is the sales charge, sometimes called an initial service charge. It's levied when you purchase units. Its primary purpose is to cover the costs the UTMC or PRS provider incurs for marketing and distributing the scheme, plus the administrative cost to open your account. This charge must not exceed the maximum amount stated in the scheme's prospectus or disclosure document and allowed under its deed. It can be up to 7% of the net asset value for some funds, which is quite significant.
And this sales charge directly impacts what's sometimes called your working money. Think of it like this. If there's, say, a 5% sales charge, only 95% of your initial capital is immediately put to work earning returns. This means a smaller portion of your investment is actually generating growth right from the start, slightly delaying the magic of compounding, where your earnings start earning their own money, growing exponentially over time. I see. So you really want as much of your money as possible actually working for you from day one. Are there other direct fees I should know about? Yes. There's also potentially a switching fee. This might be charged when you request to move your investment from one fund to another fund managed by the same scheme provider. This fee could be a fixed amount or charged on a per-unit basis. Less common nowadays, but still possible, is an exit fee, also known as a repurchase charge. This is a deduction from your proceeds when you sell or dispose of your units. It's generally less common and might be charged as an alternative to an initial service charge rather than in addition to it.
Okay, those are the fees I might see coming directly out of my pocket or reducing my initial investment. But you mentioned indirect fees too, ones that might be harder to spot. The hidden ones.
Exactly. These are the indirect fees and charges. They're borne by the fund itself, and thus they indirectly affect its net asset value, or NAV, and consequently your unit price. The most significant of these is usually the annual management fee. This is the remuneration paid to the UTMC or PRS provider for managing the fund on your behalf. It typically charges an annual percentage fee to the fund itself, averaging around 1.5% per annum for many UTS funds, though fixed income or money market funds might charge less. This fee can sometimes include performance fees, but these must be equitably computed, independently verifiable, measured against an appropriate benchmark, and importantly, they have to offset any cumulative losses first. This management fee is accrued daily and reduces the fund's NAV. It covers all the management company's operating overheads: salaries, office rent, computer systems, compliance, training, marketing, distribution costs, general administration, everything needed to run the fund.
So even if I don't see this coming directly out of my bank account each year, it's still impacting my investment's overall growth. What else falls under these indirect costs?
There's also the trustee fee. This is paid from the fund's assets to the trustee for performing its crucial oversight duties, and its maximum amount must be stated in the deed. Finally, you have other scheme expenses. These include legitimate and necessary operational costs that keep the fund running. Things like transaction costs, brokerage fees for buying or selling assets within the fund, income tax payable by the fund, auditor's fees, investment valuation fees, and maybe legal costs incurred for amending the deed.
Wow, that sounds like potentially a lot of different small charges adding up. Is there a simple way to get an overview of all these ongoing costs, like one number I can look at?
Yes, there is. This is where the management expense ratio, or MER, becomes your secret weapon, really. It's a simple percentage that encapsulates how much it's really costing you to hold that fund each year. The MER is a comprehensive measure that sums up almost all indirect ongoing expenses charged to or paid by a scheme during an accounting period. This total sum is then divided by the average net asset value of the scheme during that period, and it's usually expressed as a percentage. The MER allows you to easily assess the previous year's cost of holding units in a particular UTS or PRS. You can compare it to both past and prospective returns, compare it to the MERs of competitor schemes, and weigh it against the costs associated with other investment opportunities. A gradually decreasing MER over several years can be a good sign, indicating efficient cost management by the management company. A lower MER can translate into significantly more wealth accumulated over the long term, so it's a number you definitely want to pay attention to when comparing funds.
So a high initial sales charge means less working money at the start, and a high MER means more of your potential earnings are being eaten away quietly over time. It really reinforces the need to look closely at these costs, doesn't it? It's about optimizing the efficiency of your investment capital.
Exactly. Even seemingly small differences in ongoing costs can lead to substantial divergences in wealth accumulation over decades. For example, if you have RM100,000 invested and one fund has a 1% annual MER while another similar fund has low 0.5%, that seemingly small 0.5% difference compounded over 20 or 30 years can translate into tens of thousands of ringgits in lost potential returns. It's about optimizing the efficiency of your investment capital, ensuring as much of your money as possible is actively working for you. Hashtag TAG 4.2 performance measurement, how to evaluate the success of your investment.
Okay, so we know what we're paying in fees. Now, how do we evaluate what we're actually getting in return for those fees? It's tempting to just chase the highest returns you see advertised, isn't it? But it's vital to understand how that return was achieved, over what period, and what it actually cost you in terms of risk and fees. Measuring performance effectively means looking beyond the headline numbers. The most comprehensive measure is the total return, right?
Yes, total return is the most comprehensive measure. It represents the overall return you received from an investment over the time you held it. It's basically the difference between the amount you invested and the amount you received when you sold, plus any income like dividends or interest or other entitlements you received during the investment period. It accounts for both capital appreciation or depreciation and any income distribution. It's the whole picture. A superior measure for comparison over time, however, is the compounded annual return. This shows the average annual rate of return achieved by an investment over its entire holding period, assuming returns were reinvested. This allows for a true apples-to-apples comparison of performance across different time frames. For example, A 100% return over 5 years might sound amazing, but when compounded annually, it's about 14.9% per year. A 100% return over 10 years, however, is a significantly lower 7.2% annual compound rate. This annualization is really key to understanding the true rate of growth and makes comparing funds with different histories much more meaningful.
So how do I actually get this information, and what specific numbers or disclosures should I be looking for in the reports I receive?
Scene providers are required to issue semi-annual and annual reports to investors, and these contain crucial data points for performance assessment. You'll find things like the highest and lowest net asset value per unit during the period. You'll see the total return of the fund broken down into capital growth and income distribution components. You'll see the distribution per unit declared, if any. You'll also see the total expense ratio, MER, which we just discussed, and the portfolio turnover ratio. That simply tells you how actively the fund manager is buying and selling investments. A high number means lots of trading, which can incur costs. Crucially, they must also provide the average total return measured over 1 year, 3 years, and 5 years, or since inception if the fund is younger, and the annual total return for each of the last 5 financial years. And importantly, maybe most importantly, all performance reports must include that standard warning statement. Past performance is not necessarily indicative of future performance, and that unit prices and investment returns may go down as well as up. Never forget that.
Okay, that's a lot of numbers again. How do I make sense of it all, especially when comparing my fund against another, or just understanding where my fund sits in the overall market?
Right. For comparative performance, funds are typically ranked from highest performing to lowest performing within their category. To help interpret this, performance tables are often categorized into quartiles. Each quartile represents 25% of the total funds measured over a given period. So a top quartile fund ranks in the top 25% of its peer group for that period, which is generally considered good. It's really important to compare apples with apples, though. Funds are grouped by similar investment objectives, so you compare equity funds only with other equity funds, for instance. It's also very helpful to compare a fund's performance against a relevant benchmark. That could be the FBMK LCI for Malaysian equities, maybe prevailing interest rates for fixed income funds, or even the inflation rate. This indicates whether the fund is actually outperforming or underperforming its intended market or goal. Is it adding value above the benchmark?
So it's not just about the absolute numbers reported, it's about the consistency of performance and how it stacks up against its peers and its own target, right?
Absolutely. For long-term investors, the consistency of a fund's performance across various time periods, say 3 months, 6 months, 1 year, 3 years, 5 years, and since launch, is often much more meaningful than isolated short-term spikes in performance. Consistent above-average performance might indicate a more reliable and skilled fund manager or a sound process. Beyond just the numbers, a really comprehensive assessment also considers qualitative factors of the management company itself. How does it operate? What's its investment process and philosophy? What's the organizational structure like? And importantly, what about the stability of its fund management team? For example, have the key fund managers responsible for the fund's past success actually remained with the company, or has there been high turnover? That can be a red flag. While quantitative metrics like compounded annual return and MER are undeniably essential, truly assessing a fund's long-term viability requires combining this with robust qualitative insights. For instance, understanding if a fund's strong returns came from maybe taking high-risk, concentrated bets, or from a more disciplined, diversified approach provides crucial context about its underlying risk profile. Similarly, understanding the stability and philosophy of the fund management team can offer deeper foresight than just looking at historical numbers alone. It's really about evaluating the tortoise, not just the flashy hare. Hashtag TAC 4.3, understanding and managing investment risk, including borrowing to invest.
Now, let's tackle a word that often makes investors nervous: risk. It's frequently misunderstood, I think, and some people assume all risk is automatically bad. So what exactly is investment risk in this context, and how personal is it? Is it the same for everyone?
That's a great point. At its core, risk can be defined as the variability or fluctuation in the total return from an investment. Basically, how much its value goes up and down. An investment with high price volatility, like individual listed shares, is generally considered higher risk than one with a very stable value, like a fixed deposit. But here's the key thing. What constitutes risky is highly subjective and very personal. An investment that feels risky to one investor might seem much less risky to another. Your individual risk tolerance depends on several factors, including your investment objectives. What are you actually trying to achieve with this money? Your investment time horizon. How long can you leave the investment untouched before needing the funds? A long-term investor, maybe someone with 10 or 20 years until retirement, can typically afford to ride out short-term market fluctuations much better than someone needing the money next year. And finally, your fundamental attitude toward risk, your psychological comfort level with the possibility of potential losses. A good consultant must assess this for you through that suitability assessment we talked about.
That's exactly why having a cooling off period sounds like such a good idea then. It gives you a chance to step back and really check if the risk level matches your actual comfort level after the initial excitement, perhaps.
It is indeed a crucial safeguard. As an investor, you have a cooling off right to reconsider your purchase decision. This allows you to apply to the scheme provider for a full refund of your investment, less any specific costs like medical examination fees incurred by the provider, if backable, within 6 business days from the date of your initial application. This is a really crucial safeguard, especially if you feel perhaps you purchased units without fully understanding the scheme, or maybe felt pressured or potentially misled by a consultant. This right typically applies only to your first investment with a particular scheme provider, though, and it usually doesn't apply when you're just switching between funds within the same provider. But it gives you that short window to reflect and change your mind if needed.
Okay, now, for a topic that sounds exciting on the surface but can potentially turn into a nightmare if you're not extremely careful: borrowing money to invest. Often called gearing or loan financing. It's like adding rocket fuel to your portfolio, isn't it? Fantastic if you're heading for the moon, but disastrous if you're just aiming for the next tree. It sounds tempting to magnify your potential gains, and it can work in a rising market, but it also magnifies your risks significantly. This really isn't for the faint of heart or for those who don't fully grasp the potential downsides.
You've hit on a critical point there. It's extremely important to understand the concept of borrowing to invest. Gearing loan financing. This involves acquiring units in a scheme using borrowed money. The investor, or borrower, hopes to generate a total return from the units that exceeds the cost of borrowing, basically, the interest paid on the loan. While this can indeed amplify gains in a rising market, it equally and significantly amplifies losses in a falling market. There are specific, serious risks involved that you absolutely must understand before even considering this strategy.
Walk us through those amplified risks. What should a listener be most concerned about if they're tempted by this?
Okay, first, interest rate fluctuations. Most loans taken out for investment purposes are subject to variable interest rates, often linked to benchmark rates like the base rate or base lending rate. This means the total cost of financing cannot be predicted with certainty. Your loan repayments could go up unexpectedly, increasing the uncertainty of whether you'll actually make a net profit from the investment. Second, and this is a big one, there's the risk of default in loan repayment. If, for whatever reason, you default on your loan repayments, maybe you lose your job, the lender has the right to liquidate or sell your investment in the unit trust scheme to recover their money. This can happen with or without your consent. Crucially, the units may be sold at a time determined entirely by the lender, which could be at the absolute lowest point in a market cycle. You lose control over the sale decision and could lock in substantial losses. Any shortfall between the proceeds from the sale of units and the amount of the outstanding loan must still be paid by you.
That's a truly terrifying thought, losing control over when your assets are sold, especially if the market is down and you're forced to sell at the worst possible time.
It really is a significant risk to consider. Third, you face potential premature repayment penalties. Loans for investment in UPS are often long-term commitments, maybe up to 10 years or even longer. If unforeseen circumstances, like a loss of employment, compel you to repay the loan before the agreed date, you may incur hefty penalties from the lender for breaking the contract early. Finally, and this ties it all together, there's no guarantee on returns. Returns on unit trust schemes are not guaranteed. They can vary significantly from year to year. The timing of a disposal of units, perhaps forced upon you to repay a loan, may result in a loss, even if the investment performance was actually favorable prior to that date. You could be forced to sell at a loss simply to cover your loan obligations.
So it's definitely not for the faint of heart or for someone who isn't fully prepared financially and emotionally for those significant downsides. Is there a specific disclosure requirement for this to make absolutely sure investors understand what they're getting into?
Yes, absolutely. Due to these inherent and significant risks, the Securities Commission requires investors who borrow to invest in unit trust schemes to sign a specific unit trust loan financing risk disclosure statement. This document clearly outlines all the main risks involved and serves as confirmation that these risks have been properly explained to you and that you understand them. It also strongly encourages you to seek further information if you're unsure about anything. The margin of finance for such loans generally should not exceed 67% of the application amount, meaning you could typically borrow up to twice your initial deposit. The requirement for investors to sign this disclosure statement isn't just a bureaucratic formality. It's a critical legal and ethical tool designed to assure genuinely informed consent. The underlying principle here is that while investment opportunities involving leverage can offer higher potential returns, they also demand a proportionate understanding and tolerance for the associated risks. It's about ensuring you comprehend the full spectrum of potential outcomes, good and bad, before committing your capital using borrowed funds.
All right, so let's say you've done your homework on collective investment schemes, you've understood the fees, you've weighed the risks carefully. Now, how does the actual investment process work? And how does your consultant ensure the investment truly fits you specifically? Because it's not just about signing on the dotted line, is it? There's a whole carefully designed process to make sure you're truly informed and that your investment fits you, not just some generic sales pitch. This journey begins with understanding the key disclosure materials.
Indeed. The prospectus for unit trust schemes and the disclosure document for private retirement schemes are indispensable legal documents. They are foundational. No sale of units in UTS can legally be made without a prospectus, and no contribution to PRS without a disclosure document being provided to you first. These documents provide relevant and accurate information material to understanding the management and operation of the respective funds. They cover investment objectives, risks, limitations, policies, services offered, and of course the fees involved. UTMCs and PRS providers are also required to issue supplementary documents if there are any material changes, ensuring the information you have remains current. In addition to these detailed documents, a product highlight sheet or PHS must be issued for each unit trust scheme and for each fund under a private retirement scheme, though core PRS funds might be covered by one PHS. The PHS aims to make it easier for you to understand the key features of the product and promote competition by enabling easy comparison between different funds. The information in the PHS must be clear, concise, effective, and free from falsehoods or material omissions. So you can think of the PHS as the executive summary, giving you the key points quickly, while the prospectus or disclosure document is a deep dive into all the legal and operational details. Both are important.
That makes sense. Kind of a quick guide and the full manual. But how does a consultant actually make sure they're recommending the right product for me specifically? It feels like that's where the real value or potential pitfalls lie.
That's precisely where the critical suitability assessment, or Know Your Client, KYC, comes in. And it's an absolute cornerstone of investor protection. Consultants are legally obligated to undertake a comprehensive suitability assessment before recommending any unlisted capital market product to you. This isn't optional. This process involves gathering detailed investor information. It includes your background information. This helps conduct customer due diligence and identify any indicators of vulnerability. It includes your financial situation, employment status, income, financial commitments, assets, liabilities, number of dependents. Crucially, it'll ask about your investment objectives and needs. What's the purpose of this investment? Retirement, education, wealth accumulation, the desired duration, your need for capital protection or security, and even your preferences, like sustainable and responsible investments, SRI, or maybe Islamic-based investments. They also evaluate your risk profile, appetite and tolerance, your ability and willingness to accept investment risks. And finally, they consider your existing investment portfolio to ensure any recommendations are appropriate and complementary to what you already hold.
So this KYC process is really my protection mechanism. I need to be transparent and thorough in providing my information, and in return, I should expect tailored, justified advice that really fits my unique financial DNA, not just a product push.
Absolutely. Based on all this gathered information, the consultant must conduct a review to form a reasonable basis for the personal advice they give you, matching products that are suitable to your profile. A scheme is considered suitable if it's likely to meet your investment objectives and needs, considering your financial situation, risk tolerance, and investment knowledge. And here's a crucial rule. If, due to your financial situation, risk tolerance, or knowledge, a consultant finds they are unable to match and recommend a suitable scheme, or even one you've specifically expressed interest in, the consultant must not make a recommendation, and they must explain to you why. They're also required to inform you that providing inaccurate or incomplete information during the KYC process will naturally affect the suitability of the advice and will absolve the consultant of accountability if the recommendation turns out to be inappropriate based on faulty information. The Know Your Client principle is truly a foundational pillar of responsible financial advisory. It shifts the burden of determining suitability from you, the investor, squarely onto the consultant. It legally mandates that recommendations are meticulously aligned with your unique financial landscape and risk appetite. It's all about ensuring a right product, right person scenario. Consultants who adhere strictly to this build in valuable trust over the long term. Once a suitable decision is made, you'll complete an application form, and you will generally receive confirmation detailing the application amount received, the number of units acquired, the net asset value (NAV) per unit on the allotment date, the initial service charge imposed, and a statement indicating your current unit holdings. Hashtag tag 5.2, managing your investment beyond the initial purchase.
Okay, so you've made your investment, hopefully, into a well-matched fund thanks to that KYC process. What happens next? What are some of the key things to understand as you manage this investment over time?
Well, specifically for Malaysian investors, there's a unique feature worth mentioning again. EPF transfers and withdrawals for approved unit trust schemes. Employees Provident Fund, EPF members, are below 55 years old, can transfer up to 30% of the total savings exceeding the mandated basic savings amount in their Account 1 into approved unit trust schemes under the Members Investment Scheme, MIS. There's usually a minimum investment amount, often around RM1,000. It's important to note, though, that any repurchase proceeds money you get when you sell units previously bought with EPF savings will be repatriated to EPF, meaning the money goes back into your EPF account, not directly into your bank account. Also, switches between different unit trust management companies for funds bought with EPF money are generally not allowed. They must be processed as a redemption back to EPF first, followed by a new application to the new company. If you want to make a single UTS investment using both EPF money and your own cash savings, you'll typically need to make two separate applications. The EPF website provides detailed tables for the basic savings requirements by age and eligibility scenarios. It's a valuable option to potentially boost your retirement savings beyond just the mandatory EPF contributions.
That's a good practical tip for boosting the retirement nest egg. Now, what about how income generated by the fund affects its value? I've heard people talk about buying a distribution, and it sounds a bit like a trick or a loophole. Is it?
That brings us to understanding distributable income and its impact on NAV. The amount available for distribution from a scheme can include realized income, like dividends and interest received by the fund, and also realized capital gains from the profitable sale of investments after deducting the fund's expenses and any relevant taxation. Importantly, when a distribution is declared and subsequently paid out to unit holders, it reduces the net asset value per unit by exactly the amount of the distribution per unit. This is simply because a portion of the fund's total value is being returned to you, the investor. It's not new money appearing from nowhere. Schemes with an income objective generally make higher and more frequent income distributions than those focused purely on capital growth.
So about that buying a distribution idea, it sounds like getting free money or a quick win. But based on what you just said, it's really just getting back a piece of your own pie immediately because the fund's unit price will drop by that exact amount the next day. Is that correct?
You've hit on a crucial point and a common misconception. Where distribution entitlements are based on who holds the units on the X distribution date, that's the date after which new buyers won't receive the just declared distribution, an investor might be tempted to acquire units immediately prior to this date specifically to become entitled to the full distribution for that period. However, while you do receive that distribution payment, the unit price of the scheme will indeed fall on the following day, the X distribution date, by the exact amount of that distribution per unit. This means you haven't actually gained anything net. You've essentially received a portion of your own invested capital back, just sooner. Consultants must advise investors that doing this reduces their capital invested in the fund, as the scheme price will fall commensurately with the distribution amount. The concept of buying a distribution really highlights the critical importance of understanding the mechanics of net asset value and how distributions impact it. While you receive an immediate payment, it's effectively a conversion of your capital rather than an additional return on investment, as the unit price adjusts accordingly.
This nuance is crucial for long-term investment planning and avoiding misinterpretations of your actual returns.
Okay, got it. No free lunch there. How do I keep track of all this information about my investment performance, distributions, value as time goes on? What should I expect to receive?
Scheme providers are responsible for comprehensive reporting to investors. Typically, this happens via semi-annual and annual reports. These reports will confirm details like units acquired, the net asset value, and any charges paid. They provide regular statements showing your current unit holdings and their valuation. They offer detailed information on the fund's performance, including total return, broken down into capital growth and income components, distribution per unit declared, the total expense ratio, MER, the portfolio turnover ratio, comparisons to relevant benchmarks, and historical performance data. You'll also usually find a manager's report giving an operational review, performance analysis, and their market outlook. There will be the trustee's statement verifying management accordance with the deed and regulations and disclosing any shortcomings found. And for Sharia-compliant funds, a Sharia advisor's report confirming adherence to Sharia principles. Tax vouchers are also usually provided to help with your income tax reporting.
What if I need my money back before retirement, or maybe my circumstances change and I want to change funds to adapt to new goals? How does that work?
Right. For repurchase of units withdrawals, while investment in these schemes is generally intended for medium to long-term horizons, investors do have the right to dispose of their units or make withdrawals at any time, subject to the scheme rules. Scheme providers are legally obliged to repurchase units at the prevailing price upon receiving a valid request and must pay the proceeds as soon as possible, which typically means within 7 business days of receiving the request. However, remember, for PRS members, those pre-retirement withdrawals before age 55 from subaccount B are generally subject to that flat 8% tax penalty on the withdrawn amount, with those specific exemptions we mentioned earlier for things like death, disability, housing, or education. Switching funds is often a convenient option if you want to adjust your portfolio within the same provider. It's essentially a repurchase of units in one fund, with the proceeds immediately reinvested as an application for units in a different fund managed by the same scheme provider. Consultants should clarify any sales charges or specific fees that might be incurred during a switch, as some providers might waive switching fees while others apply them.
And finally, what about the sneaky things, the silent killers that can erode your returns, even if your investment seems to be performing well on paper, things that aren't direct fees?
Yes, those are the silent eroding factors: inflation, taxation, and investment costs. Consultants really have a responsibility to educate investors on how these factors significantly reduce your net real investment returns over time. For instance, using simple tools like the Rule of 72 can vividly illustrate how inflation, say even a modest 3% per annum, halves the purchasing power of your money in about 24 years, 72 divided by 3. Similarly, taxes payable on distributions or capital gains, and those ongoing management expense ratios we discussed, can quietly eat away at the real value of your savings and investments over the long term, even with seemingly positive gross returns reported by the fund. Knowing what to expect from your fund reports, understanding concepts like buying a distribution, and grasping the real long-term impact of inflation and fees on your returns empowers you to be an active, savvy, and truly informed investor. It's all about seeing the full picture of your financial journey, warts and all. Hashtag 5.3 investor support and professional complaint resolution. Consultants' role really extends far beyond just the initial sale. It's about fostering an enduring financial relationship built on trust. The success of the unit trust scheme and private retirement scheme industry is largely measured by investor feedback and satisfaction. After all, most new business tends to come from repeat business or referrals from satisfied existing investors. Delivering quality service involves several key aspects. Consultants must absolutely know your products well. They need to be well-versed in scheme functions, fund characteristics, and current regulations to properly assess your needs and match appropriate funds to your requirements and resources. They also need to manage expectations effectively. It is essential to avoid exaggerating potential returns during marketing. Consultants must clearly explain the various risks associated with investment and why certain funds are recommended based on your specific risk profile. You, as an investor, must realize that capital loss is a common occurrence in investing, and there's always a chance, however small, of significant loss. So it's about providing realistic expectations, not just painting a rosy picture to make a sale.
That makes perfect sense. They shouldn't overpromise. And they must also truly understand investor needs, right? Considering your investment goals like, are you focused on capital preservation or chasing high returns? Your investment horizon, are you nearing retirement or a young investor seeking long-term growth? And your existing investment portfolios to provide suitable, complementary advice that fits with what you already have. And naturally, responsiveness and accessibility seem key, ensuring quick transaction processing, reasonable total transaction times, and responsive handling of requests and queries when you reach out.
Indeed. But what happens if things do go wrong, or you have a serious concern or a complaint? How are those handled professionally, and where can you turn for help if you feel you're not being heard?
That's a vital question for building confidence. Scheme providers have a clear obligation to handle investors' queries and complaints professionally. They must establish, maintain, and implement written policies and procedures to ensure complaints are handled in a timely and appropriate manner, always aiming for a satisfactory resolution. They also have to maintain a register of complaints received and the actions taken to resolve them. In most cases, your consultant is probably the best initial point of contact for a query or complaint. They know you and your situation. However, if you remain dissatisfied after speaking with them, the consultant must know how to escalate it internally to designated personnel within their distributor's established complaint handling policies.
And if even escalating it internally doesn't resolve the issue to your satisfaction, what are the external avenues for redress then?
If it's still unresolved, a complaint can be directed externally to FEM and also to the Securities Commission. For complaints that involve monetary claims, investors can refer their case to the specific dispute resolution body, the Financial Markets Ombudsman Service, FMOS, and FIM, as the regulator for distributors, takes investor complaints very seriously. They have a disciplinary committee that investigates such complaints thoroughly. Disciplinary action, which could include public reprimand, suspension, or even revocation of the consultant's FIM registration, will be taken against any consultant found to have breached the FIM Code of Ethics. Consultants must acknowledge that handling complaints professionally is just a natural part of their role. They need to manage them effectively, demonstrating that investors' concerns are valued and taken seriously. This is crucial for building long-term trust and reinforcing the integrity of the entire industry.
That's a powerful message to end on. Delivering consistently high-quality service, particularly through transparent expectation management and proactive, fair complaint resolution, builds that invaluable trust that forms the bedrock of success in the financial services industry. It's about demonstrating genuine care for your financial well-being, which is ultimately what every investor seeks and deserves. Hashtag outro.
Wow, what a deep dive this has really been. We've truly cut through a lot of the jargon, I think, and uncovered the essential what's, whys, and hows of collective investment schemes in Malaysia. From understanding that fundamental concept of pooling your money and its tangible benefits, like enhanced diversification and professional management, to the absolutely crucial distinctions between unit trust schemes and private retirement schemes, especially their differing regulatory frameworks and those important withdrawal conditions. We've explored the robust, multi-layered oversight mechanisms involving the SC, the indispensable trustee, FIM, and the PPA for retirement schemes. And we've highlighted the importance of understanding fees, keeping an eye on that management expense ratio, how to truly evaluate performance beyond just simple numbers, and the critical ethical responsibilities of your consultant. Hopefully, you're no longer just an investor, you're an informed investor capable of seeing the full picture now.
Absolutely. The ultimate takeaway from this deep dive really is empowerment. This detailed understanding allows you to engage far more critically and effectively with financial products and the professionals who advise on them. It helps ensure that your investments are truly aligned with your life goals, your personal risk tolerance, and your financial timeline. It transforms you from being perhaps a passive recipient of information into an active, discerning participant in your own financial journey. You're equipped to ask the right questions and make confident, strategic decisions for your future.
So as you reflect on this deep dive into collective investment, maybe consider this. How might a deeper personal understanding of financial instruments like unit trust schemes and private retirement schemes reshape not just your own individual wealth trajectory, but collectively, how might it contribute to strengthening the financial resilience and retirement security of an entire nation?
Indeed. Very thought-provoking question. Perhaps linked to that, what role might you play in advocating for greater financial literacy within your own circles, your own communities, recognizing that a well-informed populace is arguably the strongest pillar we have for a stable, thriving, and equitable capital market for everyone?